We do want to get a little bit more about the fires. We've seen some estimates crossing the Bloomberg about insured losses from the fires estimated in excess of $10 billion. Our team who follows the insurance sector have definitely been working on that. Matthew Palazzola is back with us. He's Bloomberg Intelligence senior analyst covering the property and casualty space, the insurance space, joining us here in studio. Talk to us a little bit, Matt, about kind of the work you're doing as you guys continue to monitor fires that are still, maybe things are getting a little bit better, but still not completely under control by far.
Yeah, I mean, I just left my desk and checked the CAL FIRE website, and they're saying the Palisades fire 0% contained still, so still completely ongoing. The work we do with fires is generally trying to look at the structures, look at the home values in the area. I know it's obviously a horrible situation. We kind of boil it down to these dollars and cents, but that's what we're doing.
Our hearts and thoughts certainly go out to the people and certainly those who have lost their lives and their families and friends first and foremost. Yeah.
And so we ran a scenario analysis this morning, which I think we'll probably revise upwards, where we came up with like a low end of $4 billion, which seems like a very low base case at this point, and to upwards of 10 could be higher than that.
So we're going to be speaking a little later about the different entities within the state of California, private and public insurers. But in your work, who are you focusing on as the businesses, the folks who are most exposed here?
So Tim, I mean, we cover the public equities, right? So we will focus on names like Allstate, AIG, Chubb, like those are the companies that I follow. The most exposed in the state will be mutual companies like State Farm, Liberty Mutual. They have the most market share. State Farm has notably been pulling out. And there's also a state fund, which you might want to talk about. Well, it's not a state fund, but we could talk about it.
Yeah, fair. We're going to be speaking about that a little later in the program. Does this mean moving forward, we'll see more and more of these large companies move out of California and the insurance options for people who live in these areas will become fewer and fewer?
I think in the near term, that's probably the case. As I'm playing out scenarios, I'm thinking maybe it forces. The reason companies are leaving is not necessarily the wildfires. That plays into it, but they're leaving because they feel like they can't get a fair price. It's regulated in the state, right? So what State Farm and Allstate will tell you is, well, we can't price for wildfire, so that's why we're leaving.
I mean, they're publicly held entities, right? So they've got to be profitable. And if they think that there's a bad business, I mean, I feel like you go back to the heart of ESG, right? And the factors that might put companies at risk. They have to think about their business model, right? And probably don't want to underwrite situations where it's too risky.
The home insurance industry as a whole is generally not a high return business, and it's even worse in California. So State Farm is a mutual company. They're not as much focused on quarterly profit like Allstate would be as a public company. But even State Farm at some point says, enough is enough. So they can't get the prices, so they would leave. What I'm thinking, Tim, as an answer to your question is, perhaps this forces the state regulators to come to the table with a little bit better of a plan to allow the insurers to maybe price better. That's maybe a blue sky scenario, but we'll see.
So you teased that public option just in the last minute that we have with you. What's the state's exposure? How does that work? And look, again, we're speaking at a point where the fires still are raging across LA County. But what do we know so far?
Yeah, so the FAIR plan is not taxpayer funded. It was started by the government, but it is a private entity that assesses insurance companies. So the money comes from insurance companies, and they kind of run an insurance plan out of that. We're looking a little bit at the claims paying capacity. It does seem in a worst case that the FAIR plan could run out of money. Wow. Which would mean they could then assess the insurance companies more money. So they could still pay claims in that case.
But certainly, a topic for discussion, because if increasingly we see this where, whether it's Florida, whether it's West Coast, right, that are impacted by fires or other climate events. I mean, either you have insurance or you don't. Like, someone's got to have to ultimately pay for it.
I mean, you could see something like the Florida State Fund pop up in California if the insurers don't come back. But the affordability crisis will be ongoing.
All right. Really appreciate it. I know we're going to be coming back to you a little bit later on. Matt Palazzola, he's Bloomberg Intelligence senior analyst for property and casualty insurance.